Welcome back. Earlier today, the personal consumption expenditure inflation report was released. It shows real progress in the Fed's fight against inflation. We're also going to talk about the very interesting situation here with positive growth in the economy and negative inflation or declining inflation. And also, could this spell a win-win for the stock markets? Very interesting situation. First, the news. CNBC reports Fed's favorite inflation gauge rose 0.2% in December and was up 2.9% from a year ago. We can see on a month over month basis up 0.2%, 2.6% year over year. Now, the Fed's favorite inflation gauge is core PCE. Core PCE does not include food and energy, which are considered to be more volatile components of the measure. So it's thought that the Fed really watches core PCE, and we have a 2% target on a year over year basis. We want to see that 2.9 come down to that level. Here we see blue bars month over month, core PCE month over month as well, and we see a steady move to the downside. Now, these are monthly changes. It's not as relevant, but certainly we should talk about it. We see here 0.2% on both levels. So PCE, which includes food and energy, and core PCE, which does not include food and energy, they're both around the same level. They rose just moderately. I don't think it's any level of concern. On a year-over-year basis, certainly more relevant though. PCE in blue, core PCE in orange, and we can see both enjoy a steady decline to the downside. What's interesting, the core PCE is down below 3% for the first time during this entire Fed tightening cycle. It's not 2%. 2% is a target, but it is an accomplishment to say the least. Now, what's interesting also, notice PCE is at 2.6, below core PCE. So excluding food and energy, we still have some inflation. Means that food and energy, those prices are coming down a little bit faster. What's keeping inflation high? Other components of the economy, not food and energy. Now, blue line represents PCE year over year, core PCE in red. The Federal Reserve 2% target. We're heading in that direction. We're not quite there yet, but that's where we're headed to go. The federal funds is shown here in the orange bars, a white line, PCE, and notice certainly the correlation, and this is no accident. As the Federal Reserve raises rates, the intention is to cool inflation, which it certainly has done so. But notice also the unintended and pleasant consequence is that as inflation cools, that is good for stocks. The white line in this case is the S&P 500. And we can see as inflation cools, it creates a better environment for the stock market. With less inflation, we certainly can afford more from those companies listed on the S&P 500, for example. Now here, left-hand side of the chart, that's a 2008, 2009 period of time. Right-hand side, present day. Now, again, we see PCE over here on a year-over-year basis currently at 2.6%, which is very close to where we were late '08 of 2.7%. The Federal Reserve has raised rates to cool inflation. Now, the consequence of that is it also higher rates tend to slow down growth, GDP, employment, consumer sentiment, things of that nature. So the question is, as we slow down the economy, are we due for a hard landing or soft landing? Now, we wrote an entire dissertation about this in our Substack newsletter. We'll give you the link as well for that. But really, to answer this question, whether we're going to go to a hard or soft landing, a hard landing is when the stock market and the economy and the housing market really take a hit to the downside. The economy cools too fast. A soft landing is when the inflation rate cools just enough to allow for innovation and growth under a lower interest rate environment, as the Fed starts cutting rates, and that leads to the next bull run. That really is the question. There's 5 indicators that we covered in our newsletter, and I'll give you a link. It'll also be listed in the comments section of this video. Now, Federal Reserve futures, we spoke about this yesterday in terms of the GDP meeting. We had a 40% chance the Federal Reserve would cut rates in the March meeting. down to 5.0 to 525. Well, now that's gone up to 48%. Again, this is for the March meeting. We have a 48% chance of a Fed cut, 52% chance Fed will not cut. Now, why will the Federal Reserve cut rates? If there's either a decline in growth or a decline in inflation. If inflation comes down to the 2% target, the Federal Reserve will say, okay, we're ready to cut rates. That was our objective, 2%. If the economy cools, if the employment market really kind of falls apart, manufacturing's already weak. It's a question of which gets there first. Does the economy really decline, or does the inflation rate decline while still holding on to a strong economy? That is the question. And which one comes first really goes to determine whether we have a hard or soft landing. Now, green line here shows us the probability of a Fed cut. Red line where Feds keep rates unchanged. And notice on January 19th, again, we spoke about this yesterday, we had a crossover where there's now a greater chance, the red line it went above, a greater chance the Federal Reserve will not cut rates. Because, and we spoke about this, that on January 19th, we had a number of Fed speakers who basically said, we're going to slow down. We're going to take the idea of cutting rates. We're going to slow that down. We're going to cut rates this year, but probably not as much and not as aggressively as everybody thinks. Well, as a result, the red line popped up. The green line, the chance of an interest rate cut went down. The market listens. Now we see the reverse situation. But is that because the Federal Reserve speakers spoke today and said, oh, now we're going to be more aggressive? No, it's because inflation, according to today's report, the PCE, shows a decline, which is positive news. And if it's positive that the inflation rate is coming down, well, then we see the chances that the Federal Reserve will keep rates unchanged at 525 to 550. That has also declined. So the decline in the futures today is based on the decline in inflation, which means that the market says, oh, okay, the Fed has almost completely done its job. We're at 2.9%. Our target is 2%. So let's increase the probability the Fed will start reducing rates. If we also see a really awful, for example, employment number next week, and that shows us the economy is really cooling, well, that would be another reason for the Fed futures to go down. The reason why that's important is because we have money in the stock market. And based on the nuance, based on why these Fed futures go up or down, dictate how stocks move. Stocks like good growth, stocks like lower inflation. We had both of that in the past 2 days. Good GDP, declining PCE today, declining inflation. That's why the stock market's strong. Why would the stock market be weak if all of a sudden we see rising inflation, the next CPI number, for example, or we see a decline in growth? Interesting to say the least. And this is again on January 19th. This is exactly why those Fed futures moved at the time, moving away from the idea about an interest rate cut. If you haven't already, please visit our Substack newsletter, substack.com. No registration required. Simply enter our details. And you will see, for example, our latest publication, which is very timely, Hard Landing versus Soft Landing. We discussed the 5 economic reports that dictate whether we're going to have a hard landing or soft landing. And we use examples of 1991, textbook case of a soft landing, which led to the economic boom of the late 1990s, or a hard landing in 2008, which led to a lot of stagnation for quite some time. So there are long-term repercussions. Whether if we have a soft landing, that could be very bullish for the stock market for a long time to come. If we have a hard landing, it could be bearish in the near-term future, and then unknown after that. So what we're looking at right now is certainly very important. And of course, we're also on Twitter, Just the Data. We thank you for joining us. We look forward to seeing you back soon.